For the Wall Street Exclusive, I'm Joe Springer, helping you make informed decisions because you can succeed in the market. I wanted to tell you, Buffett made public what he put in his will for his widow to be taken care of if that were to happen. He talked about it, and he said quote, put 10% of the cash in short-term government bonds and 90% of it in a very low-cost S&P 500 index fund. I suggest Vanguard. I believe the trust's long-term results from this policy will be superior to those attained by most investors, end quote. Another quote, I did explain because I laid out what I thought the average person who is not an expert on stocks should do. And my widow will not be an expert on stocks. And I want to be sure she gets a decent result, and she isn't going to get a sensational result, you know. And since all my Berkshire shares are going to philanthropy, the question becomes, what does she do with the cash that's left to her? Part of it goes outright, part of it goes to a trustee. But I've told the trustee put 90% of it in an S&P 500 index fund, 10% in short-term governments. The reason for the 10% in short-term governments is that if there's a terrible period in the market and she's withdrawing 3 or 4% a year, you take it out of that instead of selling stocks at the wrong time. She'll do fine with that, and anybody will do fine with that. It's low cost, it's in a bunch of wonderful businesses, and it takes care of itself. Okay, so that the Oracle says, remember we talked about how most stocks are basically right valued, and so indexing is not a bad idea? Now the Oracle doesn't index, he thinks he can pick better stocks. And he said she's not going to get a sensational result, but he said, hey, indexing's not bad at all. Put her in an S&P 500 fund, and if there's another 2000 or 2008 and the market got cut in half that year, she can take the money out of short-term government bonds. A pretty good strategy. If you read, I published over the summer, my retirement strategy was, I said, look, take a look at CDs. CDs are paying you actually considerably more than short-term government bonds, and there's no risk in them. The only risk is inflation, and up to $250,000 a year is reimbursed by the government, and you can spread it around to other banks if you need to. Okay, so you'll get a better return than the short-term government bonds, and you can't take a loss except for inflation. And then I said put the money in the VO. On good years, take your 4% out of VO. On bad years, take it out of the CDs, and then on good years, replenish your CD ladder. Maybe you could have like 5 or 7 years of CDs coming to you. All right, I wanted to share what Warren Buffett had for his plan for his widow. And tell you I had something similar there. If you're not a billionaire, look into the CDs instead of the short-term government bonds. And you know that I like the VO over the SPY. I think it has an advantage. It has been outperforming. Maybe it will continue to, but either way, I like the Oracle's idea. And for someone that's not a billionaire, maybe CDs and the VO might be a little better. All right, I hope you found that helpful. I'm Joe Springer for the Wall Street Exclusive, helping you make informed decisions because you can succeed in the market.